Social Security benefits are one of the most protected forms of income from creditors. Your credit card company cannot garnish your Social Security benefits. Your mortgage company cannot garnish your Social Security benefits. If you have outstanding medical debt, your Social Security benefits cannot be garnished for that. If you are sued for something, even something really bad like wrongful death, for example, and you lose, and whoever sued you gets a judgment against you, they still cannot touch your Social Security benefits. They have a special protected status. And not only are these Social Security payments themselves protected from garnishment before they hit your bank account, they are also protected from levy after they hit your bank account, assuming you get your benefits direct deposited rather than on a direct express card or something like that. If a creditor tries to garnish money in your bank account, your bank has to look at your past 2 months of account history to see if you received any Social Security benefits direct deposited to the account. And if you have, the bank is obligated to protect those 2 months worth of that money and lets you use it. Now, if you receive paper checks, most of the time the bank won't protect you there and your entire balance could be levied. You have to go to court to prove that some of your Social Security was garnished. It's a process, right? So it usually makes sense to get your benefits direct deposited rather than getting a paper check for a variety of reasons, because it's almost guaranteed in the case of a direct deposit, the bank will protect at least 2 months worth of your Social Security benefits, though sometimes they mess that up and you have to go into the bank and fix it. However, there are 2 exceptions to the wall protection that is generally afforded Social Security benefits. There are 2 kinds of creditors that can take your Social Security payments before they hit your bank account and after they hit your bank account. The first kind of creditor who can take your Social Security payments is an individual with a judgment against you for child support or alimony. Okay? And the other kind of creditor, can you guess who it is? That's right, the federal government. These exceptions apply to Social Security retirement income and SSDI, the Social Security disability income, but they do not apply to SSI, supplemental security income. SSI cannot be levied or garnished, even for child support, even for alimony, not even by the federal government, okay? But regular old Social Security, the money you can start collecting from the government as early as age 62 if you have at least 40 credits, basically 10 years of work for most folks, that can be garnished for child support, alimony, or for federal government debt. So can the IRS garnish Social Security? Yes, the IRS can garnish Social Security. State governments cannot, by the way, but the IRS can garnish your Social Security. But there are some things you can do about it. I'm going to tell you what they are at the end of this video. But why should you listen to me? My name is Logan Alec. I'm a CPA. I'm one of the most sought after CPAs in the nation when it comes to tax resolution and relief. I'm highly sought after by the media, things like that. My company is Choice Tax Relief. We have saved taxpayers millions of dollars of back taxes and gotten them out of very difficult, hard situations with the IRS. If you'd like to speak with somebody about your situation, give us a call at Choice Tax Relief at 866-8000-TAX. That's 866-8000-829. You can also visit our website, choicetaxrelief.com. Fill out the form there on the homepage. We'll reach out to you. Before I get into what to do if you're facing a Social Security garnishment, also known as a Social Security levy, I want to tell you how they work step by step, as well as how much the IRS can garnish your Social Security for, and it's actually potentially a greater amount than your Social Security can be garnished for other federal government debts. So, how does a Social Security levy, Social Security garnishment, how does it start? Well, like any IRS levy garnishment, it starts with an unpaid tax debt. So let's say you file a tax return, or the IRS files an SFR for you, substitute for return, because you have unfiled tax returns. And this tax return indicates a certain balance due. By the way, if you have gotten behind on filing your taxes, watch my video on what to do if you haven't filed tax returns in years. In this video, I give you a 7-step game plan on how to approach the situation. A link to that video is at the top of the screen and in the description below. Okay, so the IRS has a balance on you. So what's going to happen? Well, between 1 and 2 months after you file your tax return showing a balance due, assuming that's the scenario we're talking about typically 5 or 6 weeks after you file, IRS will probably send you a CP14 notice. This is the balance due and demand for tax notice. This is one of the most common notices the IRS sends. It basically informs you of the amount of your unpaid taxes, penalties, and interest the IRS believes you owe, and it requests that you pay this amount within 21 days of the date of the notice. That deadline is 10 days. If the amount the IRS believes you owe is $100,000 or more, then if you have not paid the tax on the CP14 and have not otherwise responded to the CP14, then 5 or 6 weeks later, the IRS will typically send you a CP501, which looks kind of like the CP14 and essentially says the same thing. Then 5 or 6 weeks later, you'll get a slightly more seriously and aggressively worded notice, the CP503. Then 5 or 6 weeks later, the CP504. And the CP504 mentions something that the other notices did not mention. And that is that the IRS intends to levy, that is, seize, first your state tax refund, and then if that state tax refund doesn't satisfy your federal tax debt, other property as well. That if you don't do anything after receiving the CP504, you'll wait another 5 or 6 weeks. And you can expect in your mailbox the LT11. It used to be letter 1058, but now we see much more LT11s. This LT11 is your final warning that the IRS is about to take your stuff if you don't pay up or request a CDP hearing within 30 days or otherwise deal with this problem. And on the left-hand side, the first page of the LT11, you will see a tidy list of the potential things the IRS could take. This list is not exhausted, by the way. And what is the last one? Social Security benefits. That's right. Right there on your levy notice. So how much of your Social Security benefits can the IRS garnish? The IRS can automatically garnish up to 15% of your Social Security benefit amount automatically through the Federal Payment Levy Program, the FPLP. So if you receive $1,000 in Social Security benefits per month, the IRS can garnish up to $150 of those benefits per month. Now, this automatic levy only applies to Social Security benefits, not SSDI and not SSI. SSI cannot be levied at all, as discussed previously. SSDI, on the other hand, can be levied, but only under a manual levy, not through the IRS's automatic levy program. And even some straight-up Social Security, normal Social Security payments can be exempt from levy, such as benefits paid to children, for example. But the general rule for the majority of people collecting Social Security is that you can see the IRS automatically garnish up to 15% of your monthly benefit. Now, you may have heard of this protection of the first $750 of Social Security benefits from garnishment. That is not the case with federal tax debt. With federal tax debt, there is no $750 protection, okay? For other government debts, the first $750 of your monthly Social Security payment is protected from levy. But this is not the case with federal income tax debt. 15% of your monthly benefit amount can be levied even if the levy causes the amount left over, the amount you actually receive, to be less than $750. Now, before the IRS starts taking your Social Security, it will send you notice CP91 in the mail. So after the 30 days, mentioned the LT11 that I talked about previously, and this is assuming you don't deal with the issue, you don't file a collection due process hearing, that's a CDP hearing during those 30 days, right? Or you don't otherwise fix this issue, your stuff becomes fair game for the IRS to take. And keep in mind, the IRS may or may not go after all leviable income and assets at once. Oftentimes, we see retirement-related assets and income being kind of further down the list of things the IRS is prone to levy, but they certainly have a right to it. But you can be sure that they will send you a CP91 notice in the mail before they start garnishing up to 15% of your Social Security benefits. If you owe business tax debt to the federal government and the IRS has the right to collect it from you personally, it will send you a similar notice, the CP298 notice, rather than the CP91 notice. But I imagine most of you out there are dealing with individual tax debt, and that's why the IRS is garnishing your Social Security. Now, good news, action items. What can you do if the IRS is garnishing your Social Security? If the IRS is garnishing your Social Security income, or you believe they are going to garnish your Social Security income imminently, you need to act quickly. If it's come to this point, chances are the IRS's position is that it has given you more than enough time to deal with this issue. But since you haven't, they're going to take what they believe is theirs. So what should you do if the IRS is garnishing your Social Security? Well, plain and simple, you need to get tax relief. Okay? You need to argue your case with the IRS and work out a deal. Obviously, the easiest deal to make with them is a full payment installment agreement. This is where you say, okay, IRS, you win. I'm going to pay you what I owe. Just give me some time, 6 years or something like that. If you don't owe that much, they'll generally go for that without a fight. That will stop the garnishment, okay, but you're going to have to make monthly payments to them. So maybe getting into something like that would be an option to stop the bleeding if you need the bleeding to stop immediately. But beyond that, if you're looking at actually dealing with your tax debt so you don't have to pay the IRS anymore, maybe even looking at some tax debt forgiveness, you have to deeply analyze your options. A lot of folks who are in the situation where the IRS is garnishing their Social Security might actually qualify for an offer in compromise. This is an agreement with the IRS to settle your tax debt for less than you owe. And this will stop the garnishments. But you got to qualify for it. I've created other videos on this channel about the offer in compromise program. There is a link to one of those videos at the top of the screen and in the description below. I encourage you to watch that video if you're interested in settling your tax debt with the government. Now, from experience, I know that many folks in their 60s or 70s or even older who are having their Social Security garnished, they may not necessarily have a lot of cash flow, but many of them do own a home. Something like 4 out of 5 approximately of 65 to 74-year-old Americans own a home. And although they may not feel rich because they may not have a lot of cash flow, they're on this fixed income, they are house rich. They have equity in their home. The IRS counts your equity in your home against you for offer and compromise purposes. It has to be included in your offerable amount. They give you a 20% haircut on the fair market value of your home to be sure, as I've discussed in other videos. And you want to make sure you point out any needed repairs, undesirable features about your home that could reduce that fair market value. But at the end of the day, that can only take you so far, right? Especially if your home is paid off, it's free and clear. IRS is going to count that against you with an offer and compromise. So it's actually sometimes a better strategy for folks, older folks who are collecting Social Security and they're seeing the IRS take some of that, is to get them in a special hardship status called currently non-collectible or CNC status. And the reasons for this are manifold. But one big reason is that if we can show the IRS that you cannot access the equity in your home, which is if you're cash flow poor. And from my experience, I know many people who call into us in this position of their Social Security is getting garnished are, if you're cash flow poor, it's pretty easy to go find a couple lenders to reject you for a cash out refi or a HELOC or something to get cash out of your home, right? If you're cash flow poor, if you have poor credit or what have you. So if we can get a couple loan denial letters and then we can submit those to the IRS, there's a little more to it than this, but in a nutshell, we show the IRS, look, they can't access the equity in their home, right? Here's the loan denial letters. We can show the IRS your cash flow statement. That your cash flow statement shows that you're in the red or very close to that every month. And of course, the IRS has standards and ways of doing that math and caps for your expenses. But if we successfully make these arguments, we can get you in the special hardship CNC status. And probably the best part about CNC status isn't that it stops the garnishments, isn't that it prevents the IRS from collecting on you. It's that while you are in the special status, the IRS's 10-year clock it has to collect your debt that begins with the date your taxes assessed keeps ticking. See, the IRS has 10 years from the date it assesses a tax to collect that tax. However, there are things and events that can toll that time limit, meaning pause it for a time. They're called tolling events. And typically, if the IRS can't take collection activities against somebody, the collection statute is tolled during that time period. However, this is not the case with CNC status. So one strategy we like to look at for our client, especially if we're closing in the next few years on the 10-year statute of limitations on collections, is getting the taxpayer in CNC status and just letting that statute of limitations run out. So what's the end result here? The end result is the statute of limitations of collections has run out. That's the IRS's 10-year time limit to collect a debt. So the government no longer has a right to pursue collection of the tax liability forever. It's dropped off. It's dead. It's gone. And here's the kicker. The taxpayer does not have to pay the IRS a single cent. That's right. If you're able to remain in CNC status throughout that entire 10-year period, keep in mind the 10-year period can be extended for things like bankruptcy, submitting an offer in compromise, submitting an installment agreement request, like I said, right? But if you do stay in CNC status throughout that 10-year period, your tax debt will simply drop off without you paying the government a shiny cent. There are some downsides, though. CNC does not lien-proof you, for instance. If the government is letting you not pay your tax debt right now while you're in CNC status, it kind of stands to reason, doesn't it, that it would want to protect its interest if you were to, say, sell your house and you have hundreds of thousands of dollars wired to your bank account from escrow, right? It's going to want a piece of that pie. But if you can't cash out of your house anyway, and you're not looking to sell your home before your tax debt drops off in the not too distant future, what do you care if they file a lien? It's going to drop off when the tax debt drops off. Tax liens don't appear on your credit reports anymore, by the way. So CNC status is an option, especially for folks on a fixed income, because yes, the IRS can kick you out of CNC status, but they typically only do that in a windfall situation or a situation where you're making a lot more money now than you were when you were placed in CNC status. But that's typically not a future fact pattern that we typically see for folks who are essentially retired, living on fixed income, collecting Social Security. I did a whole video on current non-collectible status. You can see a link up here to that video in the upper right-hand corner of your screen, as well as in the description below. So offer and compromise in CNC status are the big kahunas, the big tax relief programs we like to get our clients whose Social Security is being garnished into. There are other programs as well. If we can't show CNC, which basically means the client has no cash flow per IRS standards, sometimes we can secure a PPIA as a partial payment installment agreement. I think I went over that option recently in more detail in my 8 ways to get tax debt relief video, which you can click over to at the upper left-hand corner of your screen. I also have all my tax relief videos in a playlist for you to watch at the bottom left of your screen. I have a free report called Tax Debt Secrets the IRS Doesn't Want You to Know About. You can download by clicking right below my face. And of course, if you'd like to talk to us at Choice Tax Relief about your situation, give us a call 866-8000-TAX or visit us at choicetaxrelief.com. All right, everybody, thank you so much for watching. I will see you in the next video. Bye-bye.